Good morning, everybody, and welcome to our Kiwibank FX market update. We've got people from all over the country joining us today, so thank you for joining us. From our perspective, we're still in lockdown in Auckland, but what we've had is some really positive stories coming out from customers who are finding ways to make things work, which is really important. And we want to share content with you that is relevant, useful for your business, and gives you something to help you focus opportunities on. Just to give you a bit of a background, Peter Hunt heads up our financial markets team, and we've got dealers based in Auckland and Wellington in the dealing rooms. And the financial market business supports the wider business bank throughout the whole of New Zealand. The dealers are working with our customers with their FX needs, trade and interest rate exposures, and work alongside all of our managers and the business and commercial managers. Peter's been at Kiwibank for 8 years, and prior to that he worked for Bankers Trust and HSBC, and worked in a customer-facing role in both ANZ and ASB. So he's got a wealth of experience. And when I was chatting to him about this presentation, he said he's seen too many market cycles to admit to, shows a bit of experience, and been through a few crises, but nothing quite like the pandemic that we've had at the moment. And the impacts of this for certain industries and hospitality businesses is one of the key industries that we've seen impacted by this. Outside of work, Peter does have a life. He's got family, and he still foolishly tries to play football, which maybe he should be taking up golf at this stage of the game. But with no further ado, thank you for joining us this morning, and I'm going to send Peter on to talk to you and enjoy the presentation.
Great, thank you very much, Neil, for those kind words. I think the term expert can be used a little loosely, so I can be an expert today, but I guess we really what happens over the future when we look back is important. But so thank you for that, and thank you everyone for joining us today. We've found that some of the we're obviously in lockdown, as Neil mentioned, and this technology is great for getting to a wider audience than we might do otherwise, and we can get around things like parking and CBD movement, etc. So right, we'll kick it off. So what we'd like to do today is basically if I just move my slide there, hopefully you've seen that move. We want to talk about two quite challenging concepts I would describe, and they are quantitative easing and negative rates. So why we want to talk about those is they have been around globally. Other central banks have used these measures, but it's the first time that they've come down to our shores here in New Zealand. So I think they're pretty topical. There has been a little bit of press around them of late. Including our own Kiwibank Economics team have put a few great videos out, so they're definitely worth checking out. Then we'll talk a little bit about our currency views, and also we wanted to touch on FX hedging, why we think hedging is important. And then finally we'll have a Q&A, so I would encourage questions all the way through, because presentations that are a bit of a monologue can be a bit dull, so it'd be better if we can have some sort of exchange as we go. And I've been joined today by Hamish Wilkinson, who is one of our senior dealers. He's based in our Wellington dealing room and is actually very busy in our customer side, dealing with a number of clients across our spectrum of clients that we talk to. Right. Before we start on the markets, it's sort of important to sort of have a recap of where we are from an economic point of view. And I guess, as I mentioned before, if we look down the bottom here, you can see that our Kiwi Economics team are really the go-to guys for this. And I'm just trying to retake what they have told me. But basically, we now see, if you have a look at the GDP here, this is GDP index back to 100 for the Q1 2019. You can see that we've had this massive fall in output through the COVID period. Now, initially, we had called a bit of a V recovery as we saw some quite encouraging signs around economic activity. Some of our proprietary indicators around various industries, etc., had picked up pretty well. So we were quite encouraged by that. Unfortunately, the lockdown in Auckland has sort of changed our forecast a little bit, and now we've described that shape as more of a U. So you can see here that that shape has gone from what we would call a V shape to a U shape. So that's kind of the main message I'm getting out of how our economists are seeing the recovery. And basically that period there, we're talking about 2 years before we get back to where we were. So this is pretty huge in historic terms for an impact on GDP. I guess the other point to make is, why are we recovering at all? And really it's around the response, and it's been led by fiscal response. So the fiscal policy is doing the heavy lifting this time around. And that's, I guess the highlight of that would be the $100 billion QE program that the Reserve Bank, that the large scale asset program, that's the 100 billion QE. And we've also had $50 billion budget package. So that $50 billion budget package, is huge by any terms. And we'll have a look at that in a moment. So the risk to that economic outlook, these are just forecasts clearly, is really around further shutdowns. And if you have a look over here, the Reserve Bank of New Zealand have given us indicators of what alert level 1 means to GDP, and that's basically a 3.8% reduction in output. Level 2 steps up pretty rapidly to 8.8. Level 3 is 19, and if we're in level 4 for any period of time, it's not a great scenario, clearly. So those are the risks to this output, but we were initially reasonably encouraged with the economic outlook. Okay, this is a fairly busy slide, and I want to go into a little bit more of the detail around some of the measures. So if we just have a look at the chart itself, you can see here's the active COVID cases peaking in the 900s, and then here's your timeline from 28th of February, seems like a long time ago now, to where we are now, 28th July, and then into August. So, and you can see we've included here the community transmission. So again, these are Kiwibank economic slides, which I'm using here. So you can see some of the measures. They're kind of too numerous to mention here. 87 education package, 3.1 billion tax relief, 50 million media support, small business cash flow loan scheme. That 50 billion COVID package I mentioned before, announced in the budget, including the rainy day, amount of 14 billion still to be used. But basically, if we have a look at what we've seen so far, we've seen a wage subsidy, and that's really been 3 wage subsidies. So we saw the initial 12-week period, whereby basically employers were able to get that minimum wage for a period of 12 weeks for those employees that they kept on their books. Through the second period, that was extended for a further 8 weeks, and now we've seen this resurgence, wage subsidy resurgence, which I think is around 2-week period of relief. So that's been, in my view, that's been a fantastic policy, and we've seen that done globally, actually. So, in fact, Germany last night talked about extending their version of a wage subsidy until the end of 2021. So, that's kind of been the core, I guess, of a lot of these offsets to the lockdown. The issue is, how do we get off this the stimulus? Second response we've seen some tax relief, various measures around depreciation and cash flow, etc. As mentioned, the budget COVID package, that 50 billion package, various targeted packages, including Air New Zealand, the media, health, international education, AJ Hackett's, etc., some of the tourism sectors. So the targeted packages are just that, targeted at various industries. And probably another measure we've seen, which is a new concept, is a business finance guarantee. So that business finance guarantee is effectively out of the Treasury. So they take 80% of any losses that the bank will make. The bank would wear 20% of the loss. And not only that, they've combined that with a term lending facility. So the banks can access funding directly from the Reserve Bank at the overnight cash rate. So very favourable funding terms and very favourable risk terms. The take-up in the first version of the business finance guarantee wasn't great. So I think there was around 150 million had been lent of a total of 6.5 billion allocated. So that scheme has recently been amended. We call it BFG2, or basically, so we're looking at 500,000, maximum out to 5 million, and 3 years pushing out to 5 years. So slightly more favourable. So hopefully there'll be a bit more take up on that. The other one I mentioned just briefly, and this is probably one of the biggest changes we've seen in New Zealand, is the large scale asset program. Which is basically quantitative easing. So as I mentioned before, that has started out at 30 billion, I think 60 billion, now we're at $100 billion. So $100 billion is the current amount that the Reserve Bank are actually able to use to buy assets. So the assets that the Reserve Bank of New Zealand are buying are government bonds, and we'll touch on that a little bit shortly. They also have an allocation for local government bonds, or the local government funding agency. All the councils together can borrow through that agency. So overseas, for example, the US Fed, they've even extended that out to credit or corporate bonds. So effectively what that means is, in the US, they're funding corporates directly by effectively investing in their bonds. So the main purpose of QE, to me, is keeping bond yields low. So because we've had all these massive fiscal spending, clearly our deficits are rising, as is our government debt. So in the absence of a large buyer of that debt, potentially the market would take those bond yields higher. So the Reserve Bank have become a very, very active player in our bond market, which is something, as I say, we haven't really seen before in New Zealand. So that's kind of what's happened. Other possible responses coming forward, which is something we want to talk about today, is negative rates, and how does that work and what does that mean? So that's a monetary policy response. That would be coupled with a funding for lending program, which, similar to that term lending facility, basically would mean that the Reserve Bank will fund the banks directly, most likely at that OCR rate. And I'll talk about that in a moment as to why that's important. Another possible response is FX intervention. So the Reserve Bank of New Zealand have this large-scale asset purchase program. So they can also buy overseas bonds, and that effectively would put downward pressure on the Kiwi dollar. So that's kind of what's happened. And just quickly, you know, what's the better response? Is it monetary? Is it fiscal? Is it a bit of both? I think with fiscal, the reality is that you have to pay it back at some time. And I think we've seen even commentary this morning around, is capital gains tax back on the agenda. Basically, you're looking at either a combination of tax rises or spending cuts, maybe one or the other, or a combination of those. With monetary policy, typically the Reserve Bank or central banks have dual mandates. So while they can try and stimulate the economy by cutting rates, the offset to that is they may create inflation. They may create asset bubbles. And arguably, we're seeing a little bit of the asset bubbles at the moment, if not the inflation. But I think the central banks say that's a risk worth taking at the moment. So those are the sort of things that they have to balance out. So as mentioned, we touched on, let's have a look at the scale of the rise in deficits, and it's kind of unprecedented. Yes, we had a GFC, but this is probably a larger impact. The other point to note is that any fiscal response clearly leads to deficits, which are sustainable for a period of time. But obviously those deficits will then flow into the core government debt that we have. And you can see on the chart on the right here that what we've got here is a percentage of GDP and the $1 billion amount. So we're getting up to $200 billion worth of debt. So they're large numbers. And you can see a percentage of GDP, that's over 50% of GDP. I guess the point I'd make on this slide is that we are probably lucky that we did start around that 20% of GDP. So internationally, that's actually been a very favourable position to start in. So as I say, quantitative easing really is about how do we issue this sort of amount of bonds and this sort of a growing debt. How do we maintain that debt at a low yield so that the government can fund itself? So really, I would describe this round of QE as helping fund the government. So that's what the Reserve Bank are trying to achieve. Keep yields low, keep the yield curve low, so we can fund the government, so the government can go on these large spending programs. Is there a risk from that? There probably is. I think yesterday, Assistant Governor Hawkesby made a comment that they are looking to use the balance sheet more. So you can see that this is a big part of their game plan. And he did also make the comment that the balance sheet will remain large for a long time. So while it's easy for the government to get into these type of programs, it's probably very difficult to get out of them. And I think we've seen that overseas when the US started to taper their asset buying program. The markets went into a bit of a spin. So it's actually quite a difficult thing to unwind. As mentioned, I think here's our 2-year swap, which is 2-year swap is really a benchmark rate that a lot of mortgages are set off. It's a wholesale rate. You can see our forecasts here for Kiwibank, but we do have a risk if we get the OCR wrong and it goes negative. Really, what I wanted to highlight here is a very important part of any QE is the curve. So that's 2-year versus 10-year. So in a normal environment, the 2-year bond would trade at a lower yield than the 10-year bond. So a government would borrow in the 10 years and they might pay, 60 or 80 or even 100 basis points, even more higher for a 10-year. And the reason for that is investors are happy the government will pay that money back, presumably, let's hope so, but they do require a higher premium for that longer term. So in normal environments, you have a normal curve, which is positive. What QE is trying to do is really flatten that curve. So they don't want to see it going this way. They do not want to see this curve going higher because a lot of that government funding is in longer dated bonds, as is the local government issues as well. So they want to flatten that curve. So that's what they're trying to achieve really from one of the objectives of QE. Okay, that's sort of covered QE for now. So now what I wanted to talk about is negative rates. So really the first comment is what is the OCR? So just quickly, the OCR is the overnight cash rate. So that is basically the one-day rate that the Reserve Bank sets and that banks effectively give surplus cash to the Reserve Bank at the OCR or the OCR lesser margin, and in certain circumstances can borrow from the Reserve Bank at the OCR, perhaps plus a small margin. So that OCR is really the start of the yield curve we just mentioned. So that's the very short end of the curve, and the Reserve Bank is always focused on the OCR. What's different this time is they're focused on the yield curve as well because they want the actual effective rate to be lower. So for the market, while the market had basically said we expect the OCR to go negative. So currently we have a cash rate of 0.25, and you can see that in early next year, April 21, we're starting to get negative OCR priced in by the market. So the OIS is basically the future rate of the OCR. It's called overnight index swap. But you can see in April next year, the market now believes in aggregate that we will see a negative OCR. And that's driven by a number of factors, including seasonal hit to tourism, further economic downturn, etc. But basically the four major banks are calling that. Kiwibank is not. So, and that may well change, but at the moment we are not forecasting a negative OCR. So here's our OCR. We maintain a very flat 0.25 before hiking well out or starting August 22. So as mentioned before, 2 years away, in line with that economic recovery. But we're well aware that there's a negative rate risk here, and we've said that's as high as 40%. So, we may be wrong on this, but that's where Kiwibank are calling it at the moment. And the main reasons for that, again, I would probably recommend watching some of the Kiwi Economics videos, Jared Kerr, or there's a recent one from Mary Jo Vergara, which is a great little 2-minute summary. But basically, the reasons are that when we saw our economic data initially, we were reasonably encouraged by that. So we're not sure economically we need to do that just yet. We've seen a lot of activity take place in an online environment, much like we're doing today. The second point is that, is it really the price of credit or is it the demand for credit? So we saw a very slow take up in that BFG, 150 million of the initial 6.5 billion allocated. So arguably, it's not the price of credit or the yield itself or the interest rate. It's a lack of demand, perhaps a lack of confidence of what's round a corner. So, would a negative OCR change that? At the margin, maybe, but I'm not sure, or we're not sure how effective that is. A third reason we are concerned about negative rates is around bank margins. And I think this is quite important. Most people would be not too concerned about bank margins or bank profitability, and that's fair enough. But basically, bank margin is really based on borrowing at X and lending at X plus 2%, or a net interest margin of, say, 190 points or 200 points, 2 percentage points. That's typically how the banks make the bulk of their money, based on the size of their balance sheet. The issue with negative rates, it's very difficult for a bank to pass those negative rates on. So a lot of the funding for a bank is sourced from retail term deposits. So given retail term deposits are very unlikely to go negative, they will be floored at zero. So the bulk of the funding for the banks won't keep going down. Yet any surplus funds, etc., that the bank have, they'll have to offload at that negative OCR. So you can see that the margin for banks will contract in this environment, and the profitability for banks will contract in this environment. Why is that a bad thing? Well, basically, stability of financial system relies on fairly healthy banks. And I would make the comment that unlike the GFC, the banks typically are in pretty healthy shape as we go into this crisis, which is great news. So the other thing about the offset to negative rates, a new concept here is the funding for lending program. So the Reserve Bank, if they do introduce negative rates, they will combine that with funding for lending programs. So what that means is the banks will be funded directly from the Reserve Bank, most likely at that OCR. So that's a way for the Reserve Bank to get around this retail deposit floored at zero. They'll just bypass it. So rather than banks having to rely on those retail deposits, effectively they can get funding from the Reserve Bank directly at the OCR. So that is an argument why negative rates could in fact happen. And the last comment we have is that perhaps we need more ammunition. Is it the time to shoot all your bullets right now? So we may be wrong, and we said 40% chance. So I guess what do negative rates mean? And it really depends on what part of the market you're in. You can see on the left-hand side here, we've seen quite a dramatic fall in retail mortgages already. Can they go lower? Yes, they can, but short of, as we just discussed, short of a largely negative OCR, there's probably a fairly limited amount of how much further they can go. So if you're in the retail market, negative rates probably doesn't mean a lot. We can't imagine that mortgage rates won't be going negative. Retail deposit rates won't be going negative. There's probably a limited further fall in mortgage rates. So from a retail perspective, or the retail part of the market, negative rates is probably not a thing. It's probably more in the wholesale market. So in the wholesale market, and what we've seen overseas, the OCR clearly will go negative. That's that overnight cash rate. That will drag down a number of government bond yields and possibly out all the way along the curve. So the government bond curve could actually go negative, or certainly a number of those shorter dated government bonds can go negative. And again, we've seen that, currently large parts of Europe have negative bond yields, Scandinavia, Japan, etc. So it's something that is happening already. Possibly for corporate borrowers, their agreements are likely to be floored at zero. So a corporate borrower typically pays a benchmark like that swap rate plus a margin. So in that situation, the borrower will probably be floored at zero, so they will still pay their credit spread. So they're unlikely to get a negative rate. But where you may see a possibility is very large corporate deposits could possibly go negative. So that's one area that could happen for a wholesale type client. As mentioned, for banks, historically rely on retail deposits. Basically, we've sort of covered this, but bank margins are going to be squeezed in this environment. This limits a further fall in mortgage rates. The offset to this is that FLP, which the Reserve Bank are just sort of floating at the moment, but that FLP would supplement a negative OCR, and that's the mechanism that they would use if they do in fact introduce a negative OCR. Finally, what does it mean for investors? And we've got another slide on that, but really it's forcing investors to chase risk. So this is happening as populations are aging, and so that's a mismatch there, because typically older people or pensioners require fixed income type assets to pay a positive yield. If that's not the case, they're forced to buy stocks to chase dividends or property. They're basically chasing more risky assets. So there's definitely a lot of risk around that at the moment. How are we going for questions there, Neil? Anything we want to break for?
Yeah, I've got a couple of questions. The first question just comes from an anonymous person. Where do you see the NZD if the RBNZ goes negative OCR?
Good question. Basically, if we have a look at the slide here, hopefully you can see that slide. We think that would be very negative for the Kiwi. So the reason for that is that's not an approach that Australia are looking to take. So we sort of start to stand out a little bit. So you can see our forecast for the Kiwi is actually, if we get this right, and it's all really contingent on this OCR, if we get this right, we think the Kiwi can actually push a little higher. Part of that is driven by a weak US dollar. But if we get it wrong, so there's an asymmetric risk here. We do feel that there's a large downside for the Kiwi, possibly as low as 50 cents. So a negative OCR would clearly be introduced for the reasons we talked about, but also part of the outcome the Reserve Bank would be looking for would be a lower Kiwi. I mean, I would comment that I would describe this episode as not really specific to currencies. Yes, the currency's been volatile, but currencies pretty much always are volatile. What's different this time is interest rates have had nowhere to go, so they're potentially going negative, and we've got quantitative easing. So that's, to me, those are the things that are different this time around. The other point about currencies is that they are relative. So what might be happening here is kind of half of that equation. But what's happening in the US or Australia or whatever that currency pair we're trading against is equally important. So, and to further that point, if we look at the Kiwi over the last 12 months, we've had a 10-cent range, basically from 67 high down to 57. So the COVID impact really knocked the Kiwi hard. So we came crashing down. But we actually recovered just as hard, and we're higher now than where we started for the year. So I think the point to make is that, yes, it looked pretty doom and gloom for New Zealand for a period there. We're a large trader. We're a large exporting nation. We rely on international tourists. We rely on international students. So any severe shutdown, and we obviously had a severe shutdown, was going to be negative for our economy and therefore our Kiwi dollar. But things turned pretty quickly, and also, things in the rest of the world may not have been that flash either. So currencies are relative, and I've described that as volatile period, but not extreme volatility, with the exception of this period through here. So the other point to note on that is that this is the performance of currencies versus the US dollar over the last 12 months. So that's the Kiwi, the chart of the Kiwi over the 12 months. You can see it's gone up slightly. So that Kiwi is up 2% against the US dollar over the 12 months. But you can see that's sort of middle of the road. So typically the US dollar has been weak. Swedish krona is up 9, Taiwanese up 7, Swiss franc 7, British pound 7, etc. Aussie dollar up 6. So yeah, we've underperformed a number of our major currency pairs. But outperform currencies such as the Brazilian real and South African rand. My point there is that the US dollar has been weak in this environment that has seen this Kiwi recovery.
Great, thanks, Peter. I've got another question that's come through from Nick. Do you think it's time to find a different measure of economic activity than GDP?
That's a really good question, and obviously starting to get a little bit more currency, if you like. Possibly. I mean, that's obviously topical at the moment with some of the budget, the terms that we use around the budget, and not trying to measure just the hard data. I guess for me, we really do need really do need data because that sort of helps the policymakers. So and really what we need is sort of leading indicators or data that's ahead of the game, not lagging data. So for example, the unemployment numbers that came out last quarter were basically, most economists have looked through that and said they weren't really very helpful. So we try and look at Kiwibank, and again, I'm not an economist here, I'm part of the financial markets team, but we try and look at a number of proprietary type numbers that we look at activity in various sectors. And that, as I say, had been reasonably favourable for the initial period post-lockdown. So we're really trying to get timely data. But I think the question may be more around, other measures like, wellness and happiness and those sorts of factors, which are obviously harder to measure. So we're kind of old school at the moment, looking at, old GDP numbers.
Thanks, Peter. I've got a question from Jeremy. If the vaccines that are currently being worked on are delayed or not as effective as promised or even taken up, do you believe that QE will continue indefinitely and the government will continue to borrow for the next few years? What problems do you see on taking more debt, personally, business and government at this time?
I don't know that the governments or the authorities may have too many choices in that scenario. So I think, as mentioned before, the balance sheet the Reserve Bank are taking on will be large for some time, and unwinding that balance sheet is going to be far more challenging than getting into that situation. We look overseas and we see the second waves in Spain and France and, how they're trying to manage that. It does feel that this thing's going to be here in one shape or form for some period of time. So, that may require a rethink from the authorities, but not really qualified to comment on that too much.
Okay, thanks, Peter. We've got a question from Neville. With New Zealand's financial sovereignty in question, with our banking dominated by foreign banks, do we have any decision-making powers, and will our national interests be safeguarded?
Well, Kiwibank is an exception to some of the foreign-owned banks, I guess. And look, if I can just quickly talk about that, maybe we feel very privileged to be in that position, and I think New Zealanders typically want to back New Zealand-owned bank, and the challenge for us is to deliver on that promise. And we're certainly trying to do that. So I think what we saw in the GFC was that some of the larger Australian-owned banks did unfortunately have a little bit of a head office mentality, and that may have impacted on some of their satellite states, if you like, including New Zealand. So clearly that's not the case for Kiwibank. All the decision makers are based here in New Zealand.
All right, thanks, Peter. I will just put a disclaimer in that Peter is our FX expert and markets expert. So some of the questions around the economies globally will have to come back to you personally on through Jared Kerr. But we've got another question here from Hex, which goes, despite our government claims of being in a good position economically, we're doing relatively the same as the US and worse than Oz. So economically, we're pretty awful relatively, right?
Yeah, I mean, it's hard to know. I think the jury's out, and I think for New Zealand, my personal view again is that, we are very heavily exposed to international trade. Our tourism sector, for example, is a larger share of GDP than it is in, say, for example, Australia, but it's less than it in somewhere like Italy, which has a large reliance, 10% or so of its GDP. I think here it's 5 and Australia might be 3 or whatever the numbers are. But so we are exposed to international tourism. We are exposed to international borders. So shutting our borders will definitely have a large impact. And we can sort of, muddle our way through with wage subsidies, etc. But, I think everyone would be aware there'll be a reckoning at some point. So the longer we keep the border shut, the more impact it will have. And I guess I'd just go back to the Reserve Bank, the sort of numbers they talk about, and you can see the impact on GDP. So clearly, we don't want to be going back into these high-level lockdowns because, we can't escape the economic impact. So I think the jury's out. We don't quite understand the virus. So we don't quite understand what social norms will look like. But again, I'd probably rather talk about FX and rates if I can. But appreciate the questions. Thank you.
I've got one more question from Phil, which how does the colossal worldwide government debt, including ours in New Zealand, unwind, as there seems very little prospect for surpluses to repay the debt?
Yeah, look, a really good question, and I don't know that anyone would be comfortable with the answers there. I suppose if you look historically, growth, we need to see economies growing and long period of time of sustainable growth to really erode the government debt down, and that would be done via sustainable rises in tax take. So our fiscal and economic update pre-election, I think, comes out September 19 or September 17 or something. So that'll be really interesting to see where we are for our own tax take. Clearly, it's going to be a pretty ugly picture. The thing to turn it around, I guess, is the stimulus now to get the economy up and running, get some momentum going, and then get some sustainable tax revenues rising through corporate and personal tax rates. As mentioned before, people are going to talk about other measures, whether it be capital gains tax, etc. That old bogey could well come back into play. And the other measure that, obviously we saw in some of the European governments post the GFC, which led to some, post the European debt crisis, which led to some large issues there. That word austerity coming in, whereby people have to tighten their belts. So, it's kind of one or the other, but I would describe it as probably both and time as well. So I think we're going to be in this situation for some period of time. And hence the Reserve Bank view that QE is not going away anytime soon. Big balance sheets are not going away. The Reserve Bank themselves had said they want to target around, or they want to be a maximum player of around 60% of our bond market. So that's clearly huge. They're a huge player, but they need other players in there as well. They can't be the only player in the market.
Great, thanks, Peter. I think that's at the end of the questions for today. So thank you for your presentation this morning, and thank you for the attendees joining us. Just to wrap up, I'd like to thank you all for joining us this morning, and really appreciate Peter Hunt's contribution, and thank you to all of our customers, professionals, and prospects who have joined us this morning, and have a wonderful day, and we look forward to Auckland coming out of lockdown in the near future. Have a great day.
Thanks very much, Neil, and thank you, everyone. Cheers.